Hi, everyone. Welcome to today's webinar. My name is Ashley Simpson, and I'm going to be moderating today. It looks like there are still a couple joining us, so I'm going to give it just another 20-30 seconds, and then we will get started. All right, everyone. Again, my name is Ashley Simpson, and I am the marketing manager for RMC Group. So I am happy to join you guys today, and I thank all of you for joining us on this call. Today, we are going to be discussing alternative methods to insuring difficult risks when the commercial market won't do. So today on the line as our speaker, we have Jessica Saba. She is our captive risk consultant here in the state of Florida. I'm very excited for her to talk to you guys. She's actually been with RMC for almost 10 years, which is a huge accomplishment. And she actually started out as an accountant for captives. So she has a very wide variety of the topics. And so she's very well-rounded within the captive. She's seen all the different sides of it. So I'm very excited for her to talk to us today and to give us more information about the commercial market, about captives, and just really helping you figure out what to do when you have difficult risks within your business. So I am going to, two more things before I hand it over to Jessica. I just wanted to let you guys know the microphones have been muted today, but feel free to ask any questions you want in the chat or the question box. And we're going to be answering questions throughout the presentation. So I am going to now hand it over to Jessica and let her take it away.
Well, thank you, Ashley. Yep, that's right. I have been with RMC for almost 10 years. And as Ashley mentioned, I haven't always been in the captive division. I started in accounting. Why am I telling you that? Well, because I don't take sales from a sales approach. I take it kind of from an accounting approach. So how can I help your business is bottom line. That's what I look at. So I've worked with various businesses across my 20 years, and I know that one of the main pain points for a business is the expense side of the income statement. It's often scrutinized, and there's lots of meetings for how we can lower our expenses. So now I'm sure you're not sitting on this webinar today with your company's financials in front of you, but I want you to do me a favor. Next time you are, I want you to look at your income statement. What does your insurance expense look like? Does that number make you gasp at all? You can even go one further for me and pull a comparative report year over year. Has that insurance expense increased over the last 3 to 5 years? Have you saved any money? Have you seen any return on investment from your insurance premiums? Well, on today's webinar, we're going to talk about the difference between traditional insurance and a captive insurance company and how it can be beneficial for your business. We're also going to discuss how captive insurance companies provide flexibility to business owners and identify 4 risk strategies that are going to help your business and, most importantly, your business's bottom line. But before we get started, I want to just make sure everybody knows what a captive insurance company is. The textbook definition is a captive is a licensed insurance company created to insure the risk of its owners. But let me break it down for you. So we have a spectrum. On one side of that spectrum, we have self-insurance. What's self-insurance? Well, that's when there's no underlying policy covering that potential risk. You are responsible for that claim, that accident, whatever it may be, 100% on your own. On the other side of that spectrum, there's traditional insurance, which typically comes with a little premium or a high premium and a specified amount of coverage for that risk. You pay the insurance company, they take care of it 100% for you. Well, in the center of that spectrum is a hybrid called a captive. Captive is a form of self-insurance because it's self-insuring the interest of its owners, and it's also getting to keep some of that money, the profit that the insurance company sees, profit that you normally wouldn't see when you are paying an insurance premium. Sorry, I have to change slides. Okay, so let's talk about the difference between traditional insurance and captive insurance. The traditional insurance market, you're going to get a bill, right? You schedule that payment for your insurance premium. You don't really think much about it until you need to place a claim or you have a problem that you need to talk to an agent with. And what happens to that premium should you not have a claim through the year? The insurance company profits. On the other hand, there's a captive insurance company. ABC business, your business, has the premium, has the insurance expense. The premium is written to the captive insurance company, and then should there not be a claim during the year, the potential profits stay within that captive insurance company, therefore staying part of the ABC business's whole portfolio of income. So let's break it down into money. So your traditional premium is $50,000 a year. You write your premium payment to the insurance carrier, and then you don't really think much about your insurance until there's a claim. And that insurance carrier is taking the bet that you are not going to place a claim throughout the year and therefore make a profit on that insurance premium that it has written. So that's the traditional aspect of it. Now, with the captive aspect of it, that profit gets to stay within your own business. The bottom line is that traditional premium would have cost you $50,000 with no ability to profit, whereas with the captive, the profit could have potentially been the entire $50,000. So we see a lot of unique risks across our business sectors that we help insure with captives. We work with loggers, truckers, doctors, hospitals, mortgage lenders, you name it. We've seen the risks in many sectors. We also know that ensuring your specific business needs can sometimes be challenging. We know that there's risks that insurance carriers stay away from. So what happens if your business can't find specific coverage? Do you just go the self-insured route where you have a rainy day fund for a catastrophic claim? Or do you just hold your breath and hope that nothing bad happens? Well, with a captive insurance company, that likely wouldn't be the case. We have access to the reinsurance market that specializes in risks that others won't insure. So when I say we captive insurance companies have access to this market. What are some of those risks, you might be asking, that are unique and we can't get insurance in the traditional market? Well, cyber liability is a big one right now. You can get the insurance, but it's going to cost you a fortune. Loss of use, clawbacks or chargebacks. We'll talk about that specific one a little bit later. So what is the reinsurance market? That's a big question a lot of people have. Well, reinsurance companies help insurers spread out their risk exposure by taking on a portion of that risk and cover losses above a certain higher limit. So what does that mean? That's a mouthful. The reinsurer is helped to limit the liability that the insured is going to face. So a specific example I can think of is we have a captive that participates in self-insured health insurance for its employees. The captive sees a huge reduction in their insurance premiums because they are self-insuring. However, they are more susceptible to catastrophic claims. And what are they going to do to pay those catastrophic claims? Well, the reinsurance will take up a portion of that risk and So let's say there's a $2 million catastrophic claim. The business says, I can only handle $1 million of that. Reinsurance says, we'll pick up that piece from $1 million to $5 million, and you won't have to pay it. You pay your premium to us instead. So that's just another way to add more risk inside the captive, therefore adding for more potential profit inside the captive, and reduces the chances for catastrophic losses. Next is captive flexibility. So captives vary greatly from the traditional insurance in the sense that captives provide so much more flexibility. Captives the policies can be custom to designed. So let's talk about clawbacks for a second. Clawbacks, or the idea of a chargeback. Many businesses face ramifications from chargebacks, because many businesses deal with contracts, they deal with commissions. So let's think of a mortgage lender, for example. We just saw a client that had $75,000 in chargebacks in just one day. If that client did not have their clawback policy written through their captive insurance company, they would have been out that $75,000, and they would have taken a hit directly to their income statement. But because they had that policy written, they were able to easily write that check from their company for the chargebacks, submit a claim to their captive company for the chargebacks, and then receive that $75,000 back. The captives see a huge increase in control. What we're seeing right now in the commercial market is rates are increasing. With traditional insurance, you're locked into a premium. You don't have any say if your premium goes up because of the market as a whole. You don't have any say over whether your claims are paid or denied. But with a captive, you have say in all of that. We work with actuaries to ensure that your business is covered for your specific perils that you could face. Actuaries price your policies based on your loss experience, not the loss experience of the entire nation. And you get to decide the thresholds of premium amounts based on your actuarial report. There's huge improvement of cash flow. Because a captive allows for more flexibility in premium payment planning, our owners are retaining that premium and investment income, which significantly improves overall cash flow. There's increased loss control. Our actuaries and risk managers that are on staff help identify your most vulnerable areas and begin to protect those areas inside your captive. It's your business's incentive to reduce or eliminate the potential for claims. Now, through the proper risk control and claims management. But that's not to say that our captives aren't submitting claims or losses. It's to say that they are more cognizant of the risks that are in their general business, and they are more apt to control those risks better by putting in proper risk management practices. We also are very aware that we can't place 100% of your traditional insurance inside your captive. And we know that you're still going to have to go out there in the commercial market and purchase insurance. But what's cool about a captive is you can write something called a deductible reimbursement policy that'll cover your deductibles from your traditional insurance. So let's take this one further. We would help you. We always know that getting a deductible, let's say for your car insurance, you want to keep it at a reasonable amount that you can afford out of pocket, right? But if you raise that premium amount, what happens to your insurance expense, the bill? That lowers because you're now taking on more of that risk. You're sharing more of that risk with the insurance company. So now what you can do is by having a deductible reimbursement policy, you can raise your insurance deductible premiums through your traditional carrier, add the layer of risk of the deductible reimbursement policy, and therefore it reduces your overall expense to the traditional insurance market, and you are still being protected in case you have a claim by having that deductible reimbursement. All right, in the traditional market, we see a lot of inflexibility with policies. What does that mean for you? That means you don't have a say. You don't have a say in your increases in premiums. You don't have a say in your claims payments. And you might not be able to find specific coverage that meets your business needs. Or there might be a policy that you want that has a huge exclusion and you can't get out of that exclusion. That exclusion is exactly what you need, so now what do you do? Something interesting that happened in 2002 was the SARS outbreak. So when that happened, it alerted the insurance industry that there was a real potential for a pandemic. And they responded by changing policy language to exclude unknown pathogens. Well, last I checked, we are in the middle of a pandemic. So I am sure many insureds across this great country are looking at their policies, wondering if they have any sort of coverage for the losses they've experienced because of this. And they're probably finding out that it's been excluded already for them. Comes a higher cost of insurance. Traditional insurance looks at your loss history the loss history of all of their insureds. Your rate goes up because of parameters, most of the time not in your control. I'll tell you this, I moved back from Indiana about 10 years ago. I'd lived up there for about 10 years, and I had completely forgotten the insurance market in Florida and was reaping the benefits of a wonderfully low premium in Indiana for my car. And when I came back here, the only thing that changed was my garaging address, but my premium went up $1,000. So as you can see, I was not in control. I had to just suck it up, buttercup, and pay the bill and move on. So back to that, I show that a study that I got my hands on concluded that several rates of insurance have seen substantial increases in 2020. The rate for general liability went up 65%. There was an 89% increase of premiums for property. And if you haven't dropped your jaw completely to the floor yet, there's a whopping 100% increase in premium for directors and officers coverage. 100%. What's happening? What's happening to the directors and officers out there? That's what I want to know. I'm sorry, I forgot to cover one thing. Coverage being too expensive. What exactly does that look like? Let's look at cyber attacks for a second. The rate of cyber attacks has increased substantially over the last decade. In 2018 alone, there was a 350% increase in ransomware attacks. Because of this increased risk and exposure, the insurance companies push back. They want higher premiums now. The insurers are often setting limits too low to for proper coverage. And these policies tend to come with lots of restrictions. I bring this up because we had a client with a significant cyber liability exposure. This exposure was discovered on something we're going to talk about next, which is a risk review. But we discovered an exposure for this client that they could have had a huge data breach. So it would have made a significant impact on their revenue, and it would take a long time to clean up should this data breach occur. So not only were our risk managers able to say, hey, you need to get this in order, but also let's get you the proper insurance should a cyber liability or a cyber attack occur. Because of this, now our business is able to further protect themselves against cyber attacks and see a new income stream from a new coverage. So you're probably thinking, what type of company qualifies for a captive? Can I just start one? So the parameters for starting a captive insurance company are Are your insurance premiums over $200,000 a year? Do you have some sort of significant risk exposure? You have a strong history of risk management and safety practices in your business, and your gross revenues are at least $15 million. So you've said yes to those, then a captive is where you need to be. It's definitely a tool that can help your business in many, many ways. Now we're going to talk about the risk strategies that'll help your business. These are risk strategies that we employ within the captive companies that we manage. We at RMC take the business of your risk management very, very seriously. As I've said, we have licensed risk managers on staff. We have actuaries that we work with. We have licensed property and casualty agents on staff. So we look at our businesses, our captive companies, parent businesses. We look at their business exposures every year as well as the business of the whole. We go over possible pain points, coverage gaps, any operational changes that the business might have experienced. We ask the probing questions that sometimes you're not thinking of. Have you purchased new equipment? Have you added a location? Have you seen an increase or a decrease in your overall revenue? We get a real grasp of what's going on within the core business so that we can make sure the captive is working best for them. When we conducted a yearly review of one of our current captives, we discovered that their business had exploded in a great way, mind you. They had added several locations. They had started a whole new product line. So now that we were armed with that information, we were able to get their new locations and their product lines properly covered through their captive, helping them sleep better at night and also increasing their current profit center. In addition to reviewing the business, we also look at the existing coverage in the commercial market. So making sure that all of your general liabilities, all of your auto, everything is being properly covered, as well as getting the most competitive rates.
Hey, Jess.
Yes.
Oh, we just got I think I was on mute a few minutes ago, but you actually answered the question about the who's the best person for a captive. So thank you for answering that. And then the other question that just came through about this risk review is, what is the cost and how long does it take?
Okay. The risk review is free. It's free for our captive clients. We look at their overall, like I said, we look at their overall risk. We suggest an actuarial study be conducted every 3 to 5 years or sooner, should there be any changes in the business. And that, of course, is at a cost. I believe currently it's around $9,500, but that is a captive cost.
Okay, thank you.
Okay, you're welcome. All right, now on to taking on more risk exposure. Well, I'm sure you're looking at this slide thinking, I don't want more risk. I came here today to better figure out how to manage my risk, and you're telling me to take on more. Well, hear me out. One of the benefits of owning a captive is the fact that you can take on more risk. But I think risk sometimes is thought of as a dirty word. Risk in your business can be anything. It can be adding another location. It can be, again, expanding your product line. There's an inherent risk in everything that your business does. But by owning a captive, you have the ability to potentially take on more of that risk because you're not sure of where you stand. So let's circle back to those chargebacks for a second. Imagine for a moment that you're a mortgage broker and you are seeing a huge increase of mortgages because of lower interest rates. That's great. That's awesome. You're going to have a huge influx of clients. Your numbers are going to go up. But with that, your numbers increasing is also the increased potential for future chargebacks. So, but knowing that you have a captive insurance company and you're properly protective with that clawback policy, you can comfortably take on more of that risk because you know it's there as a fallback. And it also has, captives have the ability to create a whole other profit center for your business, and it has the ability to budget, align budgets and business units. And by taking on more of your risk, you can control the risk instead of having the risk control you, which therefore is optimizing risks. All right, thinking back.
Sorry, Jessica. Sorry, one more thing, only because I feel like it kind of fits into where what you were just talking about. But we have another question that says, which lines of coverage have to go into the captive?
Have to go into the captive. So we sit down with an actuary and we go over your business. Do you have, what are your specific risks? Are there directors and officers? Are there legal expense that could come up that would affect your business? Anything that is, let's see. I can get back to you with specific risks, but I don't, it's a lot. It's so wide spectrum.
Because nothing has to go into the captive, correct?
Correct. Nothing has to go into the captive.
It really just depends on that specific business and what would be best fit in the captive versus the commercial market, correct?
Correct. Absolutely.
Okay. So kind of to answer that question, for that person, it really just depends on the risks for that business and, what the actuaries are kind of saying, what would be good risks to take on and what wouldn't. And those reports kind of go over that, correct?
Yes, absolutely, yes. The actuary kind of, based on the interview, defines the risk cover areas and what they should insure with the captive.
Okay. And then the other thing with that, can you create a captive just for the auto?
We cannot do that.
Okay. Perfect. Thank you.
You're welcome. All right. Now moving on to risk control. So we want to think back to that annual review for a minute and all that it entails. You get to see a really cool side effect, if you will, of owning a captive is that you have greater overall risk control. You become more aware of the overall picture of your company and the potential risk exposures that are inherent to your business. You are in control of your claims administration. You have say whether or not a claim is paid or denied. Your business gets to become strategic versus reactive when engaging with risk. What does that mean? Well, it's like a game of chess. You're thinking 5 steps ahead. Okay, so if we do take on this location, are we going to be able to X, Y, Z? Well, the captive is going to come in and answer pieces of that puzzle for you. And there's a lot more financial incentive to maintain risk control in your core business. We also monitor ongoing changes. We think that is imperative for a successful captive. We know your company's pain points, you knowing your company's pain points, identifying emerging risks in your industries, and monitoring changes in your business are an essential part of running a successful captive. We know that captives can respond a lot quicker to the changing needs of its parent company. New actuarial studies can be done, even if the business owner discovers there's an emerging risk. All right, well, that leads me up to my final thoughts. We've gone through a lot today, and I hope I didn't leave you confused. If you have any questions, concerns, if you want to know, just talk offline about captives and how they can work best for you. My information will be on the next slide. But I just want to leave you with this. you create your company's mission statement, and you value what's behind that mission statement. Why shouldn't you control your risks the same exact way? And that's my information. Take a screenshot, take it down. That's my cell phone number. Give me a call, and we can talk about anything you want to know about as it comes to insurance.
Perfect. Thank you so much for talking with us today, Jessica. I do have 2 more questions for you. One was, how long does a captive take to actually set up?
Okay, so that kind of depends on the speediness of the client. The typical process, I'd say, takes about 3 months, but I've seen it take a year. What it entails is a vetting process, and then we have to pick a domicile. We have to engage in actuarial studies. So yeah, about 3 months is, I'd say, the typical time to get it up and running.
Okay, so there's not quite enough time to get one in by the end of the year, or can it be done faster?
November 17th. I think if somebody was super, super speedy, we could probably try. We've seen it happen quicker at the end of the year. But yeah, we can definitely work with whomever and get it as fast as we can, but knowing that we are under restrictions and might not meet those deadlines, but we will work real hard to try to.
Okay, good to know. All right, well, that was the last question I had. But again, I just thank you all so much for attending today. We really appreciate you taking the time out of your busy schedule to listen to our call today. And if you have any questions, please feel free to reach out to Jessica, and she can answer any captive questions that you may have. And we would love to work with you guys. So like she said, there is still time this year, as long as we work hard and work together. So feel free to reach out if you have a business or your business in mind. And so there's still time, or we can get it done at the beginning of the year too. So again, we just appreciate everyone being here today, and thank you, Jessica.
Thank you. I did.
All right. Have a good day, everyone. Bye-bye.
Bye.